Welcome to the College Knowledge Podcast, sponsored by the College Planning Network and Paradigm Financial Group. Whether you're searching for that right fit college, applying to college, or figuring out how you're going to afford it all, you're in the right place. You'll hear from deans, admissions counselors, student athletes, and scholars from esteemed universities and colleges around the country. We'll dig deep to uncover their insight and unique experiences. So whether you're a student gearing up for college or a parent with college-bound kids, sit back, relax, and listen. Like you, we have lots of questions. Our guests have the answers, and we're excited to share them with you. Let's get started. We can send your student to the school of their dreams and send you to your dream retirement. Visit us at elitecollegiateplanning.com to get started. Hey, everybody. Welcome back to College Knowledge. I'm your host, Dave Kozak, alongside my co-host, Mr. Joe Kerins, CCPS, CFSS.
Couple more that you missed, but it's all good.
College funding experts. Today, we're going to talk about college loans, and we're going to kind of cut through some of the misconceptions and the noise out there about college loans and lay it out for you as to how it really is. Mm-hmm. I think, Joe, we spend a lot of time helping people, consulting people on college loans. But prior to having a client that we're working with in this arena, we're doing an awful lot to educate them about how the system really works. So I think it's appropriate for us to jump into this and explain it to people. So why don't you start with some of the misconceptions, Joe?
Well, there's a lot. I mean, I think probably the biggest misconception that I ultimately hear is parents assume that kids can take loans out for themselves. Yeah. Like they don't need a cosigner. They can take money out. You know, the kids can be 100% on the hook. And that, unfortunately, there's only one type of loan that they can get that's on them, and that's money from the government, the direct subsidized or unsubsidized loans. That's it. And that's capped, right? Year one, $5,500, year two, $6,500, year three, year four, $7,500. So.
Yes. I mean, when people sit down or when they ask me on the street and they're like, well, you know, we'll just borrow for college. I said, well, how are you going to borrow? Where are you going to borrow from? Mm-hmm. I said, well, there's college loans, and those Stafford loans, Joe, that you're talking about. The reality is you can borrow $27,000 over 4 years. Well, that's a drop in the bucket when you're talking about a $250,000 to $300,000 education. Even when you're talking about a $150,000 education, you still got to come up with $100K right plus to be able to afford it. So, number one kind of misconception that Joe just laid out is parents, you got to know the students don't have creditworthiness. Mm-hmm. They're not going to be able to borrow any more than the $5,500, $6,500, and $7,500 for the junior and senior year, which is total $27,000 in their own name. So at some point, we're digging to the next pocket, and the person that does have the creditworthiness, mm-hmm. hopefully, right?
Yeah, right.
So there's the federal Stafford loans. Now, there are some other loans for lower income families that exist. But there's a qualification metric for that. So we're going to leave that alone. Just assume that, for the middle America that really focuses on this type of planning, those students are limited to that. Now, let's talk about the next level of federal government loan for college.
Yeah. And that goes to this goes to the parents, but this is known as the PLUS loan. Yep. And again, there's a couple different, when you hear PLUS loans, you'll mainly hear them broken up into two categories. One is undergrad, and that's for parents only. The other type of PLUS loan is for graduate students. Yep. So the first PLUS loan, the big PLUS loan most people talk about is that parent loan.
So, Joe, what's the difference between a federal Stafford and a federal PLUS loan?
So biggest difference is, again, who's responsible for the debt.
Okay.
There's direct loans, that Stafford loan that you mentioned, that is 100% on the student. Okay. The PLUS loan is a parent PLUS loan, 100% the parent's responsibility.
Yeah.
Right?
And that PLUS stands for parent loan for undergraduate student. Mm-hmm. So it's a direct parent loan. And the student's really not even
correct
on it at all.
Yeah. And that's another misconception. A lot of parents think, well, I'll take the PLUS loan out and then I'll transfer it to my son or daughter. You can't.
Nope.
Right. I mean, that's on you. So unless the only way that your son or daughter takes it over is if they end up paying it off. But if they can't, that's 100% on you. Now, the other big difference is both of these direct loans are based off of the 10-year Treasury sale price, basically in May. They're both fixed interests. Okay, so now we get to some things you kind of look into. Okay, it's not that bad. Fixed interest, the payments for the student portion, the student direct loans are deferred until 6 months after graduation.
Or you fall under a full-time student.
Correct. Yeah. Yep. Parent loans typically start 60 days after the loan comes out. Okay, so kind of payments are different. Now, just because it's based off of this 10-year Treasury number, then they add certain points, and it's the same every year. It's an addition for the student loan and then a higher addition for the plus loan. And that is set every year for that academic year. So we now know what the academic year for the 2023-2004 interest rates will be for these direct loans. So if you happen to take one of these loans, that is the fixed interest for the life of the loan. So
what's the interest rate, Joe, for the federal student loan?
So the federal right now is at 5.498.
So 5.5%.
5.5. Yeah.
Right. And then what's the interest rate for the parent plus loan?
For the plus loan, we are right now at 8.048. So 8.05.
So 2.5 points higher.
Yep. That's it.
Just because you're a parent and you pay taxes.
Yeah.
They're going to charge you a higher interest rate.
Yeah. And I mean, we've done a full episode on the plus loans. And again, it can be very dangerous, especially because you can defer them. And I can tell you that's a major mistake, because that 8 points of interest just accrues and compounds on top of each other. There's also what do you call it when you first take it out? Why can't I think of the word?
Entrance counseling?
No, not the entrance counseling, but an initiation, like an application fee. There's
the points,
an initiation fees.
Okay,
right. The plus loan also has over 4 point initiation fee. So
wow. So the administrative fees.
Yeah, the administrative fees. So again, if you're borrowing a good amount of money, if you need to send, $40,000 to a school, if that's the cost that you're taking out in a plus loan, well, the bad thing is that your interest, like your balance, is already over $41,700. So there was over $1,700 of interest, and just add it right on the origination fees for that. So
that's it. Origination fees.
It took me a second. I was like, why can't I think of that? But yeah, that's the problem that, again, not everybody's aware of. But so if you take these, you take one and you defer it, then the next year you take another one, you defer that. You're just adding up all of this, fees and interest. And all of a sudden you're looking at a dollar amount that you'll never get out from underneath them, you know? And because it's a government loan, you can't declare bankruptcy on this. This will stay with you forever.
Yeah.
Hey, if you're in Social Security, you can't make these payments, you're trying to retire, your Social Security will be garnished. Like these are very scary. But those are what I would say the main type of government loans.
Yeah. And there's always some state loans that are available and some other things. Usually the way I look at it is if you qualify for some of the SEOG type stuff and some of the different loans that are out there for Perkins loans, things like that are lower income families, then there's typically some state money that you can get as well. But all that aside, so that's the institutional backed government loans, right? So that means the institution is saying, we need this money for this family. The government is saying, we'll lend the money. It goes by way of the school to the family. Right. It's not, you're not going to get a deposit in your account and then it's going to be a transaction between school and federal government in your name.
Right. So the bill is less, right? Like that's, or if you took the plus loan out, your bill's covered. Right. And the one thing that always has driven me nuts in the past years is loans are considered financial aid.
Yeah.
Right. And so there have been schools, and some have gotten into big trouble because of this, but they will send an award letter out and it says net cost after all aid, $0. And it looks like it's a full ride. You don't have to pay anything. Meanwhile, there's a $30,000 plus loan that's being offered as financial aid. So if you take it, you don't pay anything out of pocket, but you're on a bad track immediately. So you have to be aware of, not all financial aid is the grants and scholarships. Some of the loans, like, again, I personally believe that the direct loans for the students, the subsidy, I think if you have to borrow, I think it's the best place to start.
Yeah. I mean, low interest, fixed payments, deferral opportunity. And, I mean, again, the
skin in the game for the kids.
Absolutely.
Right? Yeah.
And, there's something to be said for having to go through the process of acquiring them every year. You're learning how debt structures work and things like that. We'll get into the debt structure in a minute, but let's talk about the institutional or government money. Now, before we jump into kind of the private loan environment, there are different institutions that have their own resources that they will lend out at the same time. And so when you get a financial aid award, you have to be very cognizant of the words they use on the line. So if it says financing option, that is not a grant, that is not a scholarship, that is a financing option. And sometimes it could be A+ loan, sometimes it could be an institutional loan, but you got to understand the parameters around those as you go to it. So
I think it was actually Lehigh. And again, it was parent had a question like, what exactly is this, Joe? And it was a $5,000 specific to Lehigh loan. And so I said, well, let's look into this before we accept it. And it actually was a 0% interest while the child is in school, while the student attends full time, 0%. And then interest would start accruing and payments begin 6 months after graduation. I said, this is one we want to take. This is a good one. They're trying to help you out here. So again, make sure that you know all the options, especially when you get that award, because some of them you may also look at and say, well, I don't want to take another loan out, but if it's a 0, use other people's money here.
Yeah, 100%.
So,
all right, so let's jump into the private environment, right? So I explain this very simply. If I was a banking institution and there was profit to be made on lending money, I would get into the business. Right. That's the way banks make money. They make money by lending out. Well, they make money by collecting deposits and then lending out 90% of the deposits. That's how banks work. Right.
Yes, sir.
And so the scary part to me in the loan environment is that there are an awful lot of institutions in the student loan world, which means it is a profitable loan opportunity. Right. That's number one. Right. Think about mortgages. How many banks hold mortgages? Thousands.
Yep.
Right? Because they make money on mortgages. How many banks hold auto loans?
I think most do. Yeah.
Now you're talking about college loans, and not every bank did. There were some special institutions for a while that were focused on that, but now, I mean, it is opened up. There are more student loan banking opportunities than ever before. So the private environment is one that I think you have to be savvy to borrowing, right? The same way when I shop for a mortgage, I want the best terms, the lowest interest rate, the no points. I want all of these things that matter, right? And I think you have to take that same perspective when you're shopping for student loans.
Yeah.
And so I get a lot of people that ask me like, well, where would you get a student loan from? And I have zero loyalty to any lending institution in my life. If a bank will take care of me, I will give them a shot at the next deal. But if they don't take care of me in the next deal, I'm not giving them a shot at that deal, right? So at the end of the day, you are bank agnostic and lending institution agnostic. What I look for, Joe, and I'll let you speak in a minute, but I look for the lowest interest rate. I look for the best fixed term, and I look for an institution that will allow me to borrow the entirety of my expected education cost. And I also look for a co-signature environment between a parent and student, where if payments are made over a certain period of time, the parent becomes absolved.
The co-signer release.
Co-signer is released, and it becomes the debt of the employed student at that point, right?
Yeah.
That's my kind of lay of the land.
Yeah. So, I mean, usually my advice, especially for first-time parents that have to borrow, is you're going to shop. And I don't just mean like, oh, do some research, because you can look on websites and say, hey, interest rates as low as 4%.
Yeah.
That's if you borrow $5,000 and your credit score is 800. Like, they're going to give the absolute lowest.
And that's locked in for a year.
Right.
And it becomes variable.
Yeah.
And
Paid back. Yeah. So, typically, again, and it's similar to almost shopping for a mortgage, right? In this concept, because for some families, the amount you're borrowing is the same.
It's going to be more than a mortgage.
But it's, you're actually going to apply to a few, right? And you're going to compare the options to what is out there, right? Because just because one lender gives a family a good interest rate does not mean that same lender is going to give the next family a good interest rate. And I have seen families that have used, they've all, like I think it was last year, family basically applied for 4 lenders at the same time. So it didn't affect their credit because they're shopping, right? So it only counts as one credit pool. And then another family shopped the same 4. And it was amazing how different the interest rates were. But it was like, okay, hey, SoFi is 11% for one family and 8% for the other. And then you look at Citizens, and the family that was at 11 for SoFi was at 7 for Citizens, but at 12 for the other family. Like I don't know what lenders look at and how they calculate things, but people do things differently, right? Well,
yeah, and I think
you got to know that.
It's a huge thing to understand. And I always, because I started in the insurance business, people used to ask me why insurance rates were different at different carriers. And the bottom line is it's called underwriting, whether it's insurance, whether it's banking, and so different statistical analysis generates different
risk
outcomes.
It's
right?
risk, right? Like for insurance or for lending money, it's kind of the same thing.
But so like I'll use the insurance as an example because I think it's easy. Some insurance companies care about your credit score. And if your credit score, and it's not a hard hit credit score, it's a average. If you've got a reasonable credit, they'll give you a better insurance rate because of credit. Well, that makes no sense. What the insurance company did is they had somebody in the nerdery somewhere, no offense to nerds, but went back and did some quantitative analysis and some analytical analysis and some actuarial analysis and was able to prove out that a certain credit score is better insurance risk. And so they took that and said, well, that's our secret sauce we can add to our insurance underwriting. Well, banks a lot of them look at similar things, but they're able to spin their information differently. And so they have their guarded underwriting techniques that they can give based on a certain data point, someone a better interest rate than someone else because all their data indicates that person's going to perform better. Right.
Yeah, what's the likelihood of being paid back? What's the likelihood of defaulting? Well, if there's more risk in giving this family, hey, who knows? Maybe it has something to do with this specific lender. Every time they've given money out to a student at a specific school has defaulted on the loan. Yeah. Well, guess what? If you're applying for a loan for that school, they're going to charge. You never know, right? I usually say, you're going to shop, you're going to apply to a few different ones, and then you have to take into consideration everything you said. What's the interest rate? What's the payback structure? Can you make payments early? Is it, hey, you can defer, but if you make a payment early, you get a bonus. Now, does that mean you have to start payments? You can't just make a payment and then let the rest defer again. Every loan is a little bit different. And usually when you talk about the cosigner, what I typically see is you'll see some that have a cosigner release of 12 months. Typically, I think Sallie Mae has a 12-month cosigner release, which means that after the student graduates, if they make payments on time for 12 months, now it's 100% passed to the student. That is the lowest that I'm aware of as far as the cosigner release.
With the more common 48 months.
Yeah, 48 months is pretty typical. And on the flip side, then there's some that are like a 15-year loan and there is no cosigner release. Now, what you usually see with those is rather than being a loan that's for 1 year of school, because a lot of lenders, it's you borrow for per year. So that means you got to apply every single year and you take loans out. There are a couple lenders out there that almost give you, I won't exactly say it's a line of credit, but that year one, they approve you for the full 4-year cost. And then you take money out of it. And each year they do a soft credit pull rather than the hard full application. But those, again, there's some good upsides with that.
Yeah, for sure.
But typically when I see that, it's the cosigners on the loan for the length, which again, 10 to 15 year payback. And usually when you also see loans that have a lower cosigner release, you're going to see the interest rate go up, right?
Yep.
Ones that have a longer cosigner release, you'll see and again, that's the risk that how soon does the bank want to put it 100% on the student? Well, that's a little risky for us, so we're going to charge more for it. So I think once you start to, really break down how long the loan's for, what's the monthly payment, and that all is calculated from the interest rate, and then the specific family on, well, how many kids do you have coming afterwards, right? Is this you have an only child? Okay, it might not kill you that you're a longer cosigner release for less interest.
Mm-hmm.
You got multiple kids that are 6 years apart. Well, you may want to look at ones that are cosigner release early so that you don't have all this debt stacking up in your name because it's still on your ledger. So, I mean, I get asked all the time, what's the best loan to take? Look, it is just like, it's the same question. How do I save for college? It depends. Every parent's, every family situation is different. Income, assets, how much money the kids are going to make when they graduate. Like, there's so many variables, so many factors.
You got to put in that work.
Yeah. And that's something that, I help a lot of my families out with, is just saying, okay, this is what it is. And here are your options. And I would, if this was my situation, if I'm you, this is what I would pick, but this is your decision.
Yeah, and I think there's another component of this too, that is the psychological component for parent and child relationship, right? I'm not saying that a child can't be responsible for the debt in terms of an agreement between family members. What I'm saying is they can't get the money without the co-signature, right? So some parents will say, well, they're going to be responsible for that. I say, all well and good. Intention is everything, right? Until they don't get a job when they graduate, or until it's the worst market you've ever seen. And all of a sudden you're responsible for $100,000 of debt. You're expecting your kid to pay, but you're still affording their rent, their utilities, and now you're picking up their loan payments. So you got to be smart about it. Joe, one thing I wanted to bring up and get some insight on is collateralized debt versus uncollateralized debt. And what's the difference, and what is a student loan?
So collateralized debt, there's something, again, that you can use as collateral. So easy example, home equity.
Yep.
Right. So you can put the equity in your house, use that as collateral, and take a loan out. So you have something that if you're basically going to default, the lender now has the right to that property. 401k loan, same thing. You're using a 401k as the collateral. Uncollateralized, there's nothing that, there is nothing to use. And typically, again, collateralized debt, you're going to see a lower interest rate. Again, there's less risk on the lender's part because they would get something in the end. So they're not going to, typically, they don't charge as much on the interest side.
I'll give a simple example. Everybody's seen those car title loans, right? So you have a car, it's worth $20,000, and you take the title in, you hand it over to an institution, they hand you $15,000 in a payment schedule, right? If you don't make that payment, they take your car. Right? That's collateral. Yeah. They got the car. They're secure because they don't care. They'll just go take your car, and they have a right to it because you signed on to it. Same with the mortgage, right? Yep. You don't pay your mortgage, guess what? Over time, they're going to take your house. Yeah. So the big deal here is that student loans are uncollateralized. Yep. And the difference between the interest rates in collateralized debt versus uncollateralized debt is almost double. Right. So what you could borrow collateralized, maybe 4, 5, 6%. And what you can borrow uncollateralized is 10, 11, 12%. Right. Yeah. So you have to be careful in understanding the best option for borrowing. If you didn't know, we have a free crash course on college funding at elitecollegiateplanning.com. This will explain different types of loans, types of financial aid, savings vehicles, and much more. Yeah. And again, I know we didn't touch on this, but as far as like where those private, because again, the government loans, we know what the interest rates are. Yep. It's different for every family from these lenders, but the best I would say that you would ever find is a loan, a student loan that has no origination fees and that you're borrowing at the prime rate, right? Usually that's, and again, now that is for people that have very high income, very high credit scores. Again, not a small amount of risk. And just to let you know, prime rate right now is at 8.25. Yep. And so that's kind of your baseline. And that's where, again, you look at saying, okay, well, if we're not that perfect family, high income, high credit score, now what's going to happen is that goes up and up and up. So, yeah. So creditworthiness dictates interest rate. And really, just to be clear, so I oversimplify it, creditworthiness is simply a bank's confidence in your ability to repay the money. If they're confident in your ability to repay, they will charge you less interest. Can't say it's a fair system, but it's the reality, right? Yeah. Bad financial awareness and bad financial planning leads to more expense to access money.
Yeah. And also you're going to have private loans can be different, that you can choose fixed options. You choose variable options. Yep. So again, we never know where interest rates are going to go. You might have had families last year, right, that let's just say they had a variable interest rate for student loans based on the prime rate.
Yeah.
Well, guess what? Their interest doubled in the span of a year.
Yeah.
Went from 4% to 8.25. Like, wow, that's a big difference.
Yeah, and that payment is affordable at the 4%, and then all of a sudden it kicks the financial plan of the budget right in the butt.
So yeah, be aware, again, when you're shopping, know the difference between variable and fixed.
Okay.
Yeah.
So there is no recipe for the right loan. It's a matter of doing the homework.
Mm-hmm.
Any shortcuts you think are reasonable for people to look at when it comes to the loans?
Shortcuts?
Yeah, like any ways to get good information about loans and who's in the game, who's lending out money and.
Oh yeah, I mean, there's as far as like a website, like a kind of like a guideline. There's actually a couple that I like. Simple Tuition is kind of like a lending tree. You put information in, it'll basically kick back. Hey, these are different options that are out there. I will make sure that our producer gets this link in there, but it is fineaid.org. They have a very good article that's updated constantly that I send to all my clients that have to go into this, because it gets into not just, hey, these are good loans to look at, what their interest rates are, but it talks about a lot of what we're talking about. Yeah. What is a good interest rate? What is the cosigner release? How much can you potentially borrow? So that I think is a great website. And it's finaid.org. It's /loans/private student loans. That's the actual website. I'll make sure that it's in the description today. But that one I like because it pretty much features a couple loans, and then it tells you, okay, what are their limits? How do they work? What are their potential limitations? So it gives you a more in-depth look rather than kind of the marketing kind of grab you numbers. It's more in-depth. That's usually what I talk to people about. It'll tell you the different terms that are available, the different, are there fees involved? And it breaks it down for each loan that they basically highlight. So there's a lot of that are out there. I usually, advise to look at Discover and Citizens because they offer that bigger kind of, again, easiest way to kind of compare it is the four-year
lump
loan,
sum.
right? Sallie Mae, again, because there's a lower cosigner release. Look at your state. So like for Pennsylvania, it's FIA. There's a PA forward loan. Look at that. And then basically have a conversation with somebody that knows how to break this down into layman's terms for you and knows your financial position so that they can give you proper guidance. So that's why I was joking and saying, is there a shortcut? That doesn't sound like a shortcut to me, but I mean, that to me is like the minimum amount of work.
Yeah.
So I wouldn't say it's a shortcut. More
of a launch point, right?
Yeah. At least it gives you a starting point on how to understand some of these different loans that are available.
And I'll add one more thing to it. Because college loans are profitable for banks, a lot of banks are involved in them now.
Mm-hmm.
So step number one, I would go to your local bank that you use and ask the question, do you guys do student loans? How do you do them? What are the interest rates?
Mm-hmm.
Because banking is always easier where you have a relationship than starting a new relationship, right?
Yep.
Now that doesn't mean it'll be right for you. So don't discredit these other things, right? People ask me all the time about the Discover program. I think it's a great loan program.
Yeah.
Right. They do a nice job managing their underwriting. They do a nice job getting the money to you. And it doesn't scare me. People are like, well, they're a credit company or a credit card company. Well, what's the first word in that? Their credit first, right?
Yeah.
Card is just the way they issue their credit. So, again, you got to shop around. So, Joe.
Yes, sir.
Let's talk about the elephant in the room. Loan forgiveness.
Oh, God. That's where you want to go?
I do. I want to go right there right now because everybody listening to this is going to be like, well, I could just take the loan and they'll be forgiven anyway. So, you know.
Yeah, it's funny you say that. I had somebody call me yesterday and literally said, hey, our daughter's going to be a nurse. Our friends told us that if you're a nurse, your loans get forgiven. So don't pay for college. Take as many loans as you possibly can.
Can I get a ding buzzer? Can I get something?
The laugh.
No, not the bell. The bell doesn't work on that one. We need the.
Look, the only loan. Well, number one, I'm not going to get into. I mean, unless you want to get into it, the whole government forgiveness that is happening now, right? Number one, if you're taking a loan right now, it doesn't even apply for that.
Yep.
Right. This is something that was, again, proposed and then set back. And hey, you had to have loans distributed before, I think, July 1st, 2022. So if you're taking loans now, it doesn't even apply.
And just as a general premise of borrowing, for the love of everything, if you ever get a loan forgiven, great. Good for you. You won. However, if you borrow money and don't have an intention to repay it, you are just setting yourself up for failure, period.
Yeah. And look, everybody, right, can have, if they have a specific loan on them, their responsibility can be forgiven. And that's when you die. And then it could pass on to someone else.
Yeah.
So now, not all loans, but again, that is unfortunately, if you play that game, is what people's solution ends up being the most financially viable option. Now, government loans are the only loans that have some type of true forgiveness on them. Okay. And mainly you're going to be talking about what we discussed earlier with the plus loans and with the direct loans. Now, how they get forgiven is a couple different areas with that. Number one is there's a public service loan forgiveness. So if you work in the public sector, and this is something, again, that is being proposed and changes being made, where it used to be like 20 years of payments. Now they're talking about 10 years of payments. But the idea is you have to make a payment towards these loans if you work for the government, if you work for the state, if you work for, potentially nonprofits. Like you have to, there's a lot of ins and outs to know if you would qualify for this.
Now, hold on.
Yeah.
Because I just want to make financial sense of this for people.
Mm-hmm.
Right now, a government job pays less than a private sector job.
Mm-hmm.
That is a known fact. So what they are essentially doing is trying to offset their lack of employment opportunity and payment with a loan forgiveness potential. They do not equal out over their lifetime. So number one, I'm not saying don't go into public service. I'm in no way saying, I'm just saying there's no such thing as a free lunch. It doesn't happen. They're getting their money out of you one way or the other. They're getting their money out of you by not paying you what you should earn for your expertise in the field, or they're giving you a loan forgiveness in that. Mm-hmm. But it is not there's no freebie in that. Right.
Well, because herein lies the problem with what I was about to get to.
Sorry.
You're good. No, we're on the same page. Is that the payments, you still have to make payments. It's not like you don't make payments and loans get forgiven, but it's you have to make a certain percentage of your annual income. You have to make that minimum payment for the 10 or 20 years, whatever exactly it's going to be defined as. So if you go into the government, well, the only way to basically have that payment be lower is to make less money. Exactly what you're saying. Okay. Well, if you make more money, or hey, you do end up getting a higher paying job, there's a lot of people out there where it turns out that the loan forgiveness payment is the exact same payment as if they're paying the loan off in 10 years. So you're not actually you're paying your loan off. That's how it ends up working for a lot of people. And so that's where I think a big misconception is people say, oh no, I just pay like $500 a month and I never pay. No, you're going to pay when most of these loans get forgiven. You are either making a very low income for 10 years or you're just paying the loan off as usual. Correct. That is essentially, again, how that works. Okay. Outside of that, again, loan forgiveness, not ideal situations
Joe,
beyond that. So-
Let's, again, you already said this, but I want to reiterate this point. Is a bank going to forgive your loan?
No, that's the biggest side of that. There are private lenders. And again, very simply, all the stuff that the government was trying to forgive, it did not include any type of private lending
Correct.
loan. It was only federal government.
Just to be clear, we already established that you can borrow $27,000 as a student.
Mm-hmm.
And you take on another $125,000 for your $157,000 education, or $152,000 education. In the best case scenario, you're going to have a low income paying job and you're going to pay for 10 years on loan. So let's just assume with that $27,000, you paid off $10,000 to $15,000 of it over 10 years, right? You're going to get forgiven the $10,000, but you still have the other $125,000 or $130,000 in debt on the other side with accrual and interest and all that. So it is just not, and unfortunately, it became a politicized topic, which it never should have been. Because it was a political ploy to make people think they weren't going to have to pay for college anymore, and that's just not the reality. Mm-hmm. Joe, have any colleges reduced their price you've seen this year?
Well,
some have,
but I say they lowered their advertised price.
Okay,
I'll put it that way. Right, what they're actually taking in. No, I'm not aware of any schools that actually ended up asking families to pay less this year than last year. I'll phrase it that way, if that makes sense.
So at the end of the day, the college tuition prices continued to go up. The loan amounts didn't change. Mm-hmm. The idea was you weren't going to have to pay for that expensive education. It was just materially false and perpetuated by the media. And it's a shame. But I dealt with that question for 2 years. Mm-hmm. What about this loan for you? We should just take the loans, right? Well, guys, you don't understand how the loans work. Mm-hmm. That doesn't account for literally only one facet of loan, which is the federal loan. So again, put all that aside. Private lending is never going to forgive a loan.
Right. Because the only other type of forgiveness that exists from a outside of that is, again, extremely low income.
Yep.
It's disability or death.
Yeah.
I mean, that is where the other types of forgiveness come into play. So again, guys, if you're trying to plan to take loans out and then have them forgiven, you're basically looking at, well, I don't make money, I am disabled, or I die. That honestly is what the loan forgiveness will truly be applied to. And I don't think that that's any situation that anyone wants to actually actively plan to have. So not the way that you should go about thinking loans. Think about it as, I'm going to pay this back. What impact is that going to have on my cash flow, on my liquidity, on my availability to borrow more if I need a car, if I want to buy another house? That's how you have to plan this out.
Yep. So 2 questions, and then I got to split. You can continue. But the first is, can you consolidate student loans? And then what's the best way to pay back student loans?
So the answer to the consolidation is yes. And again, I think once you are in that position where you're ready to consolidate, you wait until you're done borrowing.
Yep.
And then it's exactly what we were talking about earlier. It's the shopping. There's the federal government does offer some consolidation, right? The lenders, and there are some very interesting companies that don't necessarily deal in the business of lending
the initial loan,
but then taking them all off, and wrapping them into one loan on the back end. Yeah, they exist. But it's the same thing. You shop, research, see what the options are. What is the interest rates? Are there co-signers involved? What's the payback structure? How does that affect your cash flow? I mean, the answer is yes, you can consolidate. And the federal government also has a pretty interesting consolidation factor as well, especially if you're struggling with payments. You can extend, hey, it was a 10-year payment plan. I want to push it to 20. I want to do an income driven. I want to do a graduated where, hey, I might make less money when I graduate, but I'll make more 5-10 years down the road. So, hey, I'm going to graduate my payments. There's a lot of different consolidation options available. And then as far as what were you asking the other one? How do you pay off student loans?
Yeah, like how do you plan for it? What's the best way to do it?
God, that's a loaded question.
I will answer that question. You budget, you stick to the budget, you make the payments, and you live within your means when you have debt. right? I mean, at the end of the day, what you can't do is defer student debt, pick up credit card debt, and have just a debt cycle going on, right? So I think the point that I wanted to bring up there was, and Joe, you can talk about a live scenario, but you know, if you graduate with $100,000 of debt on your back and you make $50,000, $75,000 a year, what's that repayment? What does that leave for all the other parts of life? Because if you're not planning appropriately at the onset of debt, so my key for debt repayment is understanding where you stand today, where you expect to be tomorrow, and what the debt repayment structure is going to be and how you're going to pay it back. So what my patented line is, don't ever borrow without the intention to repay.
Yeah. And I've had some people, you maybe chime in on this, but Joe or Dave, I have an account balance over here that's growing at 6%. Why wouldn't I just borrow the money and then you let this grow more, and then on the back end, use that money to pay it off?
What's it growing in, Joe?
Oh, I don't know. Like a 401k.
So borrow at X%, earn at Y%. And then at the end, take all of the Y growth and put it to the X debt.
Yeah.
Well, what if Y growth doesn't happen?
But it always has.
All right.
I'm just going with the answer I usually get.
The point is, guys, like you can't accept debt and then expect to invest in variable instruments, equities, whatever, and have it pace the interest. And, you know, it may work for a year, it may work for 2 years, but the year it doesn't work, right, it all falls apart.
It blows everything up.
I mean, Bernie Madoff.
Yeah. And the other side, and again, because that's usually the one I get, is like 401ks. Hey, well, when we're done, right, I'll be 60 so I can have access to this. Well, but then, you also, what's the 401k when it comes out? It's what?
Taxable.
Oh, so I got to take out more than, it's not just a flat number. So I usually don't like, and again, this past year is the easiest example of where that fails. Market's down 20% and interest rates go from 4 to 8.
Yep.
Done. Your entire plan is blown up in 1 year. Not something I usually would recommend.
All right. We got to end it there because I got to fly.
All right.
If you want to talk more, you can. Otherwise,
you know what? There's just one other thing that I do want to highlight. And it mainly gets into, I think most students and families don't understand the actual impact. And when I do workshops on student loans and paying for college and such, I basically say, hey, the average salary out of college is $50,000. And so with that $50,000 salary, after benefits, after paying taxes, right, you're left with a net take home of about $36,000. So $36,000 net equates to a $50,000 gross starting salary, right? So then I show families, okay, if you start adding debt each year of college, what does that actually look like now as a starting salary? And so what I mean by that is, let's just say we took only the direct government loans and it was all unsubsidized, so it all accrued interest. Well, your annual direct loan payment at that point, estimated, would be about $4,000 total, right? So now that's after tax payments that go away. So your net income after that $4,000 went from $36,000 down to $32,000. Okay, so now you're basically $32,000 net income equates to a $44,000 gross starting salary. Okay, so wait, we just immediately looking about at your kids having that they took out a loan now essentially has them with a starting salary less than if they didn't. Okay, and again, I don't think that $4,000 a year is not manageable. The kids won't be boomerang students where they go off to college and now have to live with you. I think it's manageable. But now let's say that every year the student has to borrow $5,000 additional in a private loan. Okay. Now that's going to add another $3,800 of after-tax payments. And so now our net take home is $28,000 a year. So now our gross equivalent is $39,000. So we've got an $11,000 annual reduction for 10 years because of that extra $5,000 that was borrowed per year. If we add another 5 to that and we borrow $10,000 per year, now our net take home is $24,000 a year. The equivalent of the gross there, 34.5. Right. So now we're over $15,000 reduction in a gross starting salary. $15,000 borrowed a year. The gross equivalent starting salary is now $29,000 a year. And if you basically say, hey, you got to go to a state school and you're going to borrow, you're going to be 100% responsible for the debt. They borrowed $5,000, the government loan, $27,000 over 4 years, $20,000 a year, right? You're looking at a net take-home income of $16,000 per year. The equivalent on a gross, if you didn't have debt, $24,000 a year, right? So wait, we're going to go to college and be in this much debt to have a starting salary, the equivalent of under $25,000 a year. Doesn't really make sense in my world, right? I thought the idea of going to college was to make more money. And where eventually this plays a big factor in helping families determine is when it comes to the school choice, where they are looking at school A versus school B. And hey, if mom and dad can bring $20,000 a year to the table, and that covers the full cost of school A, well, hey, if your kid graduates, they make 50 grand, they get to keep all of that. Whereas school B is the school the kid wants to go to, but that's going to cost $40,000 a year. And the student says, oh, I'll just borrow. I'll figure it out. And the problem is, well, now you're setting yourself up for failure, right? And that's the conversation that I've been able to help students understand the actual impact of what student loan debt will be. When you say to that student, okay, when you graduate, would you take the job that has the starting salary of $50,000 or the one that has a starting salary of $25,000? And obviously every student says 50. Well, yeah. Well, if you go to that school, you're setting yourself up to take that job that's only going to give you 25. That is how the true impact of what student loans are. And again, if your net take home on a $50,000 annual salary is $16,000 a year, you ain't living on your own, right? Mom and dad are still covering your payments, your food, probably your car payment. I mean, it is a very low net take home income, but that's the real impact that families need to be aware of when they start talking about school choices and borrowing for college. That was the last piece that I just wanted to tap into. I know Dave had to leave early, but appreciate you hanging with me for these last couple minutes. We will see you again next week on our next episode of College Knowledge. Thanks so much for being with us today.
Thank you guys for being a part of College Knowledge. Just a reminder, if you're sending your student to school, visit elitecollegiateplanning.com for free resources and to book a free consultation. Thanks for listening to the College Knowledge Podcast with your hosts, Dave Kozak and Joe Kerins. We hope you enjoyed this week's exploration of higher education, sponsored by the College Planning Network and Paradigm Financial Group. That's all for this episode. See you next time.